Good afternoon and welcome to Call on Your Chamber, presented by the Byron Center Chamber of Commerce. My name is Jennifer Lukasich and I'm the Executive Director of the Byron Center Chamber of Commerce. Today we're going to focus on the investment puzzle, putting the pieces together, taking an in-depth look at the stock market and our risks. We appreciate you taking the time to join us today. As we go along, please feel free to send any questions you have through the chat on your screen and our presenter will answer them before you leave today. I want to give a special note of thanks to strategic partners listed on your screen. These businesses have invested more heavily in the Chamber and our entire community to help make this webinar series possible and to support our other programs and services to our business community. We're pleased to offer video sponsorships for our webinars. Today's sponsor is Van Singel Fine Arts Center. I now introduce you to their Managing Director, Sarah Bauer.
Hi, Jen. Thanks for having us on. We're so excited to be here. As so many of you know, we're entering what will be our 23rd season this coming year. And the Van Singel has been an integral part of the community and a very attractive amenity that's brought countless families, empty nesters, retirees, and businesses to Byron Center. And as we've been expanding that community piece of the Van Singel Fine Arts Center, our legacy these past couple of years has been focusing on not only giving our community an opportunity to see what's on stage, but also be on stage. So as we continue to have great support from our community, as we build that community theater program and a youth theater program for our kids, we ask that after COVID-19 and our world kind of resolves those challenges and we come up with a new normal, we would like to remind you that the arts educations in our community, these wonderful community organizations such as the Van Singel, those places might need a little more TLC than most years and might need some more support. So as you're thinking about charitable giving, please remember to keep us in mind. We're so proud to be part of the community, and we're so proud and grateful for the generosity and the patience that you've extended to us and many of the other nonprofits in the area during this challenging time. We're thinking about you. We're proud to be part of the community, and we hope to see you soon.
Thank you, Sarah. I can't wait to get together and see what talent you bring to the stage. I'd now like to introduce today's speaker, Sheri Postema. Sheri has been a financial advisor with Edward Jones for 7 years, and she and her family have called Byron Center home for 20 years. Her office is located in downtown Byron Center. Sheri is driven by providing solutions that has strong passion for helping others understand and achieve their financial goals. She is very vested in our community, serving on both the Chambers and the Byron Community Ministry boards. Welcome, Sheri.
Hi, Jen. Thank you. Good afternoon, everybody. So wanted to go through some things with you, talk about some market conditions, kind of what we see as we look out going forward. And there's a lot of good data on these slides. You know, there's always that balance between how much information do you share, how I don't want it to get, like too much data, but we'll go through some of these fairly quickly. So to start with, 2020 started where 2019 left off. 2019 was a really strong year in the market. It was up close to 30% in total. So we had a banner year. We were kind of moving into 2020 in the same vein, and market conditions obviously quickly changed as the COVID virus spread. So a lot of pieces of the different investment puzzle, we'll kind of look at those together. This is showing that this looks over the last 10 years, going back to 2010, and it says what did the S&P 500 do during that period of time. So you can see the projection, and then you can see 2020 again, just how it's dipped from there. Just kind of a little side note, S&P 500, what that is it's the largest U.S. companies, 500 of the U.S. companies that are made up of that index. So there's different sectors, energy, consumer discretionary, materials, communication, etc. So there's different weights of how much is in that S&P 500 in total. But there's 500 large companies within the U.S. represent that index. This gives us some information going all the way back to 2019, and it says, okay, what's it been doing? I mean, obviously just since the end of the year. So you can see the yellow line, we're tracking along. January 30, who declares that public health emergency, January or February 24, what took place, March 11, etc. So the market did dip as low as close to 34% of a dip from February 19, which was the high, until March 23, which was that low. Thankfully it's been going up since that point, but that's kind of been the movement. So this is a health crisis. It's not an economic crisis. Health data is driving a lot of the market reaction. So, we feel that a lot of the bad reviews and the projections are already priced into the market, which we'll talk about that in a little detail in a minute. So again, the market low was March 23, and we are probably about 20% up from that bottom that we were at as of that point. So just in the last, 5-6 weeks, it's really bounced back up. So here we're looking at going back, 30, 50 years in total, to say what has the activity been. And you can see each of those blue, kind of light blue shaded areas is a big, a bull market, a bear market per se, where the market dips by 20% or greater. So these different things, there's the inflationary situation back in the early 70s, there's the tech bubble burst, etc. There's 08, 09 in there. You can see how some of those impacts have been, but yet that line, the higher number, say the 406% rate of return for the last 11 years, that's how the bull market, or when the market's up, that's how that's kind of been a trajectory. This is a good summary to say, okay, of a bull market, again, when the market's up, typically that lasts for 6 years historically, as we go back a number of years, and it's grown by that 252%. A bear market typically lasts 13 months, and the average fall is that 29.7 number. So again, you can see historically we're in a bull market a lot more of the time than we are in a bear market. And markets, bull markets don't die due to old age; they die of fright. Just like what's going on now. People they fear things and fear the unknown, and the market responds accordingly. So here's some good data just to say, a lot of times when you're in this kind of a situation, you feel like this is different. This is not, I can't get through something like this, but we go through these periods of uncertainty often, historically. We go through a 5% or a greater dip every 10 months. We go through a 10% or greater swing every 2 years. And every 4 years for 15% or greater swing, about every 8 years for a 20% or greater swing. So, and then that bottom box shows when that activity last occurred. So, again, this is normal activity, I like to tell my clients, even though when you're in the midst of it, it sure doesn't feel like it's very normal. So here's some different viral outbreaks over the past 20 years. So we had SARS in 03, swine flu, etc. And you can see how the market reacted and then how it recouped from there. So, there's certainly been other situations like this that we have been in. This is showing how it has performed. If you just look at that orange squared off box, it says from the start to the peak, what that market dipped for those different epidemics along the left-hand side, and then a month after the peak, what the market looked like, and then 3 months later, what it looked like. So obviously you can see on average 1 month later, it was up 12.3, 3 months later, it was up 23.1. So, the stock market is still the greatest revenue generating tool. Unfortunately, it comes with a couple bumps and bruises along the way. It's not always a nice steady, whatever percent increase each year. So GDP is gross domestic product, and it's pretty much what with the U.S., what we generate for goods and services. And 70% of the U.S. GDP is generated by consumer discretionary products. It's like you going to the movie theater, you traveling, you buying a car, it's consumer spending. And obviously with this lockdown going on, that's pretty much come to a standstill. So that's a big impact to our GDP. Another portion is investment, and then another portion is government spending. But clearly 70% is the most from the consumer discretionary. A recession is defined as 2 consecutive quarters of negative GDP growth. So, we're already obviously projecting there. We know we're in a recession, even though we're not quite yet through that full 6-month time frame, but that's the technical definition of that. The economy has grown a little over 2% over the last 10 years, and we really think it's going to rebound in the second half of this year, that once things kind of get loosened up and people can get, millions of people back to spending and doing some different things that they had been doing before, that will start to pick up. This is looking at unemployment rate, how it rose obviously from historic lows. Now, in February, that percentage was at 3.5%. As of the end of April, it bumped to 14.7%, so quite a difference. The one indicator, or the one fact there, is that 80% of those unemployment numbers were termed as temporary layoffs. So, that's a good sign, is that hopefully that rings true, that the majority of the people get back to work again. So we feel inflation is really near that Fed target. So the rate of inflation is a measure of the consumer price index, obviously how much are goods and services costing year over year. So inflation has been low over the last 11 years, and the Feds are doing everything they can to keep it in that low range. Housing improvement was looking good. We were on a nice trajectory there. We came into this with a strong economy, and that will matter as we come back out. So you might hear different things on the news to say, will this be a V or U-shaped recovery? And what that means is, a V-shaped would be we hit the bottom and we just zip right back up again. A U-shaped is a little more of a gradual incline. We really think it'll be more like a U-shaped recovery, and it could be a little bumps along the way, obviously, but it might take a little bit of time to gain some traction and pick up from there. Stocks, the market is a very future looking mechanism. So typically the market is bottoming out and kind of recalibrating and picking up from there about 3 months ahead of what the economy is doing. So a lot of, you might be thinking, well, God, all this negative news is coming out about unemployment and, inflation and all this stimulus money and what have you. And how come the market seems to be kind of settling, if not picking up a little bit? Well, the market, again, typically is looking out about 3 months ahead of where we are now. So that's why it's already pricing into the numbers what's going on, and they're kind of looking out through the, separating the forest from the trees to say, okay, let's see what that might look like going forward. So, all right, a couple of slides here on election year. Obviously, that's going on too, although it doesn't maybe feel like it so much, but consumers have more confidence about the economy when their preferred party is in office, which I guess kind of makes sense. So you can see that the blue line is the Democrat line, and then the red is the Republican. And then historical average during a political cycle is typically the third year the president is in office is when the market is the highest. So that kind of rung true last year for Trump. How do stocks perform following elections? So equities tend to perform better when the current president is reelected for whatever reason. I mean, probably because we're familiar with those policies. We kind of know going in what might this look like for the next 4 years. So that's just showing you there to show the yellow line is if that incumbent won a second term. The green is if they lost. So average returns in before and after an election, typically 12 months leading up to about 7.6 average rate of return, and then after about 6.4. So we really don't think politics is a long-term driver of the markets. It's kind of a blip in the election year. So this is saying, keep a long-term perspective. This shows if you invested $10,000 back in 1970, just let it go on the S&P 500 and all those large companies. What would that have done for you over all those years? And so you can see your 10,000 turned to 1.3 million over that length of time, and the average rate of return was 10.5%. And that takes into account all those gray big world events that went on, those big bumps and crashes or what have you, the end of the world, the sky is falling type of activity. So again, still average of 10.5 rate of return, which I'm not going to find that in a lot of places. So, and this just shows too, we move from one period of uncertainty to another. There's always, you just think you're past something, and then lo and behold, something else comes up. So, know too that the S&P 500, it's not just an index. It's not just kind of some pie in the sky. It's like those are companies. That's AT&T, Procter & Gamble, Coca-Cola, Johnson & Johnson. You're going to the store and buying their products. You're using their phone services, etc. It's these companies. That's what's generating that rate of return. So it's really good. Sometimes you can over review your portfolio. This is showing, if you looked at same time frame over those 50 years of time frame from, or 49, I guess, December of 1970 to the end of February of last year. So if you looked at your account balance daily, just again, if you were 100% in the market, ownership in companies, daily, 54% of the time you were up, 46% of the time you were down. If you spread that time horizon out a little bit more and did, okay, let's look at a month span of time, you can see how that looks different. A year, 3 years, 5 years. So it's just really important to say expand that time frame. I know when you're in the midst of it and you say, oh, my account value, I lost this amount today, and I looked at my statement and it went down by this, but if you can expand that time frame and say, okay, let's look at it over a year, let's look at it over 3 years. And really it's all about, typically most people don't have 100% of their investments all in the market. There's other ways you can not sustain some of those big swings, but this is just a good data point to say, boy, if you can look at that over a bigger stretch of time, the numbers look a lot more, I guess, appealing. So chance of a positive return over time. So if you did, that first column says if you had 100% just in U.S. stocks. The next one says if you had 65% in stocks, 35% in bonds, the more kind of conservative end. And then the third one is 65% stocks, and then you have some international in there too, still 35% in bonds. So same thing, as you look out over time, if you go all the way out to say a 10-year rate of return, you can see that this is saying positive return over 10 years is 99.7% of the time, 100% of the time. So that diversification really does play a key role in that. This slide is another good one just to say diversification. Each of these colors, these boxes, is a different investment type. So like maybe that purple, that light purple is a foreign stocks, or the light yellow is like a bond category. So this is showing you from 2005 to 2019, and at the top there, that's the best performer for that year, that segment, and the bottom is the worst performer. So obviously you can see not every year the same color is at the top, it kind of bounces all around, and so it's good to have a mixture of all of those in your investments, because last year's winner isn't necessarily the next year's winner, so you can see things rotate. This is showing to say the different colors. The blue is during the course of a year. You can see the years along the bottom. During the course of the year, how much did the market swing? Just throughout the course of the year, January 1 to December 31. And then the green is saying, okay, let's do that as a full 12-month block of time. Let's snapshot it from January 1 to December 31. So like, for example, let's look at, some of my years I can't see them exactly, but let's look at that last one that shows it dipped as much as 7% throughout the course of the year, but the whole year from start to finish was up 31%. That's 2019. So you can see throughout the course of the year that movement's always happening, but same thing, if you can expand it and say, show me it for the full year, what does it look like? Boy, okay, that's doable. And you can see the green, how over going back to 1988, how most of the years it's up. Don't chase performance. So sometimes you feel like it's somewhat just that intuitive where you feel like, boy, if my value's dipping, I need to do something. I need to get out. I need to sit in cash just to protect myself. But this is showing if you back from 1985, so that's 8,500 days that the market was open during that span of time, and over those 34 years, if you missed even the 10 best days during that time frame, your difference from 128,000 to 59,000 is a 53% difference. So you can see, as much as you might think you're doing the right thing to just really get conservative and sit in cash, the next day, and I think the slide shows this, the 20 worst trading days are on the left, the 20 best trading days are on the right. And a lot of times, just as quickly as it's the worst day, the next day it's the best day. So, it just goes to show it's important to know what's your purpose of those funds. Like how much can you have in the market versus how much are in bonds. And then according to that, I help my clients. Let's make sure we're in the right mix. Let's make sure we feel really good about where this investment lineup is, but it doesn't work to be jumping in and out. So stocks and bonds often move in opposite directions. So a year, the green is the stocks and the yellow is the bond line. So in a year when stocks are down, typically bonds are up. They kind of offset each other. So another good reason to make sure you are diversified. If you're not wanting 100%, if you don't want to be at the tip of that roller coaster and like be all in the market where you're grabbing the gain in a good year like last year, but now this year, you're going to feel the brunt of that dip, then we kind of reclassify so we have more on the bond category as well. So stay invested in a balanced portfolio. This is showing if you had 65% in the market of your mix and 35% in bonds. So, kind of on a scale 1 to 10, 1 conservative, 10 aggressive, this might be a 6 score. So it's showing if you were, the first line, that stock market line, is saying if you were 100% in the market, this is the impact to your portfolio during those different market periods of time. So let's follow that across. The bear market says the tech crash in the early 2000s, if you were 100% in the market, your account value dipped by 46%. And then the next 5 years, the housing boom, you went up 115. And then 07 to 09, you went down 55. And then now this last expansion, you went up 493%. So when we average all of that out, you see you averaged at 217%. The next line says if you were in that 65-35 split, if you had 35% of your mix in bonds, then you can see the tech crash, you felt 20% of that impact. You didn't feel quite as much of the uptick during the housing boom. You didn't feel quite as much of the downturn in 08-09, and then the expansion didn't grab. Obviously 493 is different than 168, but look at that number. Your ending number, your average overall rate of return is the same, 217. So, if some of those big swings are uncomfortable to you, then there's certainly value in having a portion in that bond side of things as well. So I help my clients make sure, we really go through what are your goals? What are you using these funds for? Maybe it's your emergency fund. Well, that's certainly, we don't even put that in the market. Or maybe it's I'm trying to save for my children's weddings down the road, or I'd like to be able to give them a portion of money when they get married just to kind of get them started off, or it's my retirement. So I really get to know my clients and understand what is the goal of the funds, and then partner with them very closely to say, let's go through this and let's make sure, I'm your advocate, and I'm here when things get rocky like it is now. I often say to my clients, I'm the one that's here. I'll hold your hand, we'll get over this rocky bridge together, and it's going to be okay. So, but if anyone has questions, wants a second opinion, whatever, want to sit down and just, go through some things, I'm happy to do that. Like I say, I've been part of the Byron community for over 20 years. My office is 84th Street, right across from Pete, so right here downtown. And there's no cost or obligation. I'm certainly not a high pressure person, so would love to help in any way. But yeah, so that's what I had. And Jen, I don't know if anyone has questions. Do you have to do something, Bill? Oh.
Thank you so much, Sheri. I was muted for a second there, but so much information to consider. And I guess what the main gist of it all is to say that there's no real reason to start freaking out or be concerned as long as you have somebody that's guiding you, and there's things that you can do to adjust so that you don't put yourself in a position to lose a lot.
Exactly.
So I do have a couple questions that came through. One was, what is the greatest risk to a smaller investor, like less than $10,000? Does that make sense?
Well, it's kind of the value really doesn't matter so much. It's more how much time do we have to get that money invested. So if you had 5 years plus, that'd look different. I mean, certainly if you had 20 years plus, it'd look very different than if you only had, we'll say, 1 to 5 years. So it really depends on how much time you have. Like if you were 25 years old, I say that, I'm like, if you were my child, which my kids are about that age, I'd say put 100% in the market. Because as we look at that history, over 90 years of history, your greatest rate of return is the more you have in the market. But it depends on how much time you have, because certainly if you're wanting to start to draw from those funds in 10 years, we might not have time to recoup from something like what we're going through today. So there's really not, I wouldn't say the dollar value matters so much. It's more, what level of risk are you comfortable with? What happens when we go through a situation like we just did? How do you react? It's kind of telling. If a person says, oh yeah, I get it, it's going to be okay, but then we go through something like this and that really kind of rocks them, well then we're going to scale back, because we don't want you just jumping out of the market and staying in cash. The other thing, keep in mind, is if you stay in cash, you're losing your purchasing power. Obviously inflation continues to tick up each year, 2-3%. Your cost of buying milk and gas and what have you, it continues to go up. So as much as you think your money is real safe in cash, which it is, but your $1,000 today might be worth $998 next year, type of a thing. So you want to be doing something to keep pace with inflation so you can stay ahead of the game.
Okay, that's good advice. Weren't we already headed into a recession before COVID-19 hit? And so the system was already ready for a crash. Did this just help?
I don't think we were headed that direction. You always hear people in the media, or just different people throwing out, oh, there's going to be a recession, this and that. No one can predict that. I mean, obviously now there's enough indicators that says, yes, we're going to get there. But prior to this, no. We were in the longest bull market. Being that 10, 11-year time frame, knowing that typically every 5 to 6 years we go into a 20% or greater swing, we were double the time of that. So, like I say, markets don't die like bull markets of old age. They die of fear. Something happens, something kind of jolts things. And so, I wouldn't say we were headed that direction. I think a lot of people felt like, hey, it's going to happen at some point, which we all knew. But truly, if the COVID wouldn't have come about, all projections were 2020 was going to be another banner year.
Okay. And then all the other questions that came up through the chat, you answered through your presentation. So you're very thorough in that way. So at this point, I'd love to just conclude and say thank you for your time and your expertise. And if anybody does have any further questions, Sheri's information will be made available. And again, thank you to Sarah Bauer of the Van Singel Fine Arts Center. And just thank you to Phil Teets for his support in the background, and Bill Sullivan for his support, technical support. And just thank you to everybody for signing on, and take a look at our website for upcoming events. This is your chamber signing off.